Starting a TTR or an account-based pension. So a TTR stands for Transition to Retirement Pension or an account-based pension. When can we start this? We can start this from the age of 60. So whether we should is its own discussion, but we can. So a lot of people think, well, you can't touch your super till 67, or you can't touch it till 70, or you can't touch it till you've retired. No, you can start to access it from the age of 60. So that effectively then, again, opens that door a little bit of going, oh, I didn't know that was the case. So how does that start to work? It depends upon your work status. So the full pension, the account-based pension is if you meet a certain status of ceasing a position of employment or you've retired over 60, again, with these other episodes we've done deep dive on this, so I won't get too stuck on that, you can move your full balance to complete pension phase. You pay no tax on that internally. There's a minimum you've got to take every year of 4%, but there's no maximum. So you've got full reign of that. If you haven't stopped working, you haven't retired, the first one is the TTR, a transition to retirement pension. That is, you move a portion or most of your super fund across out of an accumulation fund to a TTR fund, often still with the same provider, and you can access up to 10% a year of your balance tax-free, what you take out.
But the growth is still 15% while you're working.
It's still internally taxed like accumulation is, yes. But what that might do, let's say you've got 300,000 in super, you can move or let's call it 310. Yep. You leave 10,000 behind for your future work contributions to go into. You move 300,000 into your new TTR pension, and you can take out 30,000.
Why would someone need to do a TTR strategy if they're still working and over 60?
So it might be that the first point of supercharge your contributions. Martin, Glen, that sounds great, but I don't have the money to do that. I know I can put in 20 grand a year. I just don't have the cash because I've still got a mortgage or I'm raising kids or I've got bills to pay. Well, hold on, you're telling me I can get 30 grand a year out and either A, that can start to go off my mortgage, or B, I can take that out as a TTR pension, put that back into super as a personal contribution.
Why would I want to do that?
Because then you get to claim that back on tax.
Right.
So 20,000 out, so keep it back at 30,000 out, comes out tax-free. So my TTR pension's gone from 300,000 down to 270 and I've got cash in the bank. I guess I said, if I've still got a mortgage, that's a fast way to start to pay my mortgage off pretty quick. And if you've listened to episode on the 50s, that's how we start to pay the mortgage off quickly. And or I've logged on my ATO report, I figured I've got some catch up or carry forwards to do. I can send that 30,000 back into my accumulation super fund. That's a personal contribution. I need to check with the fund and fill in a form with the ATO called a notice of intent to claim. Again, which I think there's videos on this channel talking about how to do that. I can then claim that back on my tax return. So let's say I'm earning 80,000 a year. That 30,000 brings my taxable income from 80 down to 50. If I paid tax on that from my employer during the whole year and paid tax on 80,000, I get to save about $9,500 in tax that I would get back as a physical tax refund by doing that bit of paperwork. There's a bit of paperwork there. We've simplified that as we like to do, but there's a strategy there where you can take some money out of your transition to retirement pension, move it back into super, move it back in tax effectively, and get a nice tax refund as part of that process.
The reason I wanted to ask you the why is because it's not to be confused with a recontribution strategy.
Correct.
And maybe we'll get into that in the slides, but we'll move on from point 2, that it's in your 60s, if your whole super balance is still in accumulation, there could be a discussion with your advisor to actually move that to a TTR pension for some tax flushing.
Yeah, and there'd be
legally.
Yeah, again, personal situations. When would I want to look at that? If I've still got a mortgage, definitely. 2, if I've got some concessionals I can use but I can't otherwise afford them, I would definitely be looking at that. 3, I know if I've got that big medical bill or I need that car or whatever that is, we don't want to get too discretionary, but if I desperately have a need, that's a window there that wasn't open at 58.
Yeah, and traditionally another reason that you might do that, which we haven't talked about, which is why it was designed in the first place, was that
You might be
literally what was on the box,
transitioning
transition to retirement.
I've gone from 5 days
5
to
days
3 days.
to 3 days, and I'll supplement because I still need the full 5-day income. We'll supplement that and work 3 days a week, and life's good. Now, I would probably hypothesize and caution actually using that strategy for what it's intended, because it could be an underlying thing of you might be living on more than you might be riding too high on the horse, or
Not going to be sustainable in the future.
Yeah, so we just really want to make sure that if you do drop down to 3 days a week, that you hopefully can live off that money. Maybe. Because I don't know, do we want to, it depends how much is in your super account though, but do we want to be eating our retirement assets earlier to play golf if you're not in a financial situation to do so?
Yeah, and often when you've gone from 5 days to 3, it's 40% less work, but because of the tax system and the scaled tax system, it's usually not 40% of after-tax incomes being dropped, because you might have slid down a tax rate or your top tax reducing.
And maybe it is a bit of a rule of thumb that you might only do that TTR if you do have quite a healthy super balance, if you do still have a mortgage and you just actually want to start, your spouse might be a bit older and have already retired, and you want to maybe
you drop down to 2 days, you're not fully retired, that's your window. But again, just because we can doesn't mean we should. Examples of when I might not recommend to someone to start a TTR. If you're 61, you're still working, you don't have a mortgage, you fully maximise your concessionals, you've got savings in the bank, you've capped out your concessionals, your non-concessional, well then you don't need an extra $3,000 a month surplus or a $60,000 TTR pension payment.
Yeah.
So in that case, we may not start a TTR.
And I think maybe what I'm saying with this TTR and access to super and all that, if you are physically able to work and you're not in a good financial position, you probably need to consider continuing to work to clean up a mess or get into a better financial decision. And that could just be a reality rather than, I can access an extra $20,000 a year. I've got all this, I'm living on week to week and all that, because we just don't want to spend tomorrow's money today if we don't have to.
The fundamentals of good cash flow and being out of debt and just because we can. Well, that's a $30,000 holiday year I'll take. Well, that's probably not going to help your long-term planning.
Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.